Hi, I'm Richard Murphy, and this is the 26th in the video series on the importance of tax transparency that I am hosting, and which is being made jointly by the University of Sheffield, where I work as Professor of Accounting Practice, the Global Initiative for Fiscal Transparency, and the International Budget Partnership. In this video, we look at how a tax authority should explain why tax owing to it is not paid in the period. We think this is a vital extension of the process of accounting for tax that we began describing in video 25. Doing so, we build on the discussion on non-payment of tax in videos 11 and 12. In particular, we will look at two techniques that can, in our opinion, help any tax authority. As my University of Sheffield colleague, Professor Andrew Baker explains.
Two more advanced and even aspirational aspects of the principles name-check two forms of assessment that each have a specific purpose. The first is something Richard has done a lot of work on and is called a tax gap estimate. The purpose of a tax gap analysis is to calculate what tax is actually collected in a given time period compared to what potentially could have been collected. This gives a government, citizens and civil society a sense of the extent of revenue underperformance and the size of additional revenues that could be recovered if the tax system could be made to work more effectively. A tax gap analysis, if applied and used correctly, can help to make tax work. To complement a tax gap analysis, governments could also undertake a tax spillover analysis. A spillover analysis is a methodology of surveying processes and experiences within a tax system to identify where the contradictions, weaknesses, and risks in that tax system lie, and then grade them according to the actual risk they create. We have created a template to guide such a systematic survey. While a tax gap analysis gives a reading of what the size of missing recoverable revenue might be, a tax spillover assessment helps governments and civil society actors to understand the most likely sources of that missing revenue. In that fashion, a spillover analysis can help to identify a targeted reform agenda that can help government recover missing revenue more effectively. At the very least, a tax spillover assessment would become a source of detailed information on tax system performance that can feed into more informed debate on tax policy and tax system performance. In that sense, it's an important element of an advanced tax transparency regime. If tax transparency itself often operates on an annual cycle, tax gaps could also be reported on a yearly basis to give the government and the public a sense of whether the tax gap is increasing or reducing. Spillover assessments are more substantial and would maybe be done every 3 or 4 years. They could then be reported alongside the tax gap estimates. This would enable societies to reflect collectively on what steps could be taken to address any tax system underperformance.
These processes are included in the aspirational gift tax transparency principles. But as Andrew explains, they develop ideas we have already discussed in this series.
Having a transparent tax system as well as transparent informed tax policies that can be evaluated in terms of their performance and the extent to which they meet their stated objectives requires more than just the release of data. Transparency requires policymakers to explain their own objectives and priorities and their strategies for accomplishing them. This involves being clear about the assumptions being made and some explanation of why those assumptions are justified, as well as how they relate to the broader social and economic policy objectives of the government. Reviewed against more quantitative data, this will enable both the government and a range of civil society actors to reach more informed judgments on whether such assumptions were warranted and have been borne out by experience, or if evidence suggests they need to be revised and refined. This will also require some reflection on who is benefiting from particular tax policies and why they are benefiting, usually considering this by income stream and social grouping. In addition, in an era when some governments are attempting to offer tax exemptions and incentives to encourage investment and growth on a highly differential basis, who benefits from such policies and their distributional and growth implications requires careful scrutiny and oversight. If tax is to be truly transparent and not an opaque series of complex, partially concealed favours and advantages, such steps are crucial. Deviation from anticipated outcomes is a big theme in the intermediate principles. Tax can be unpredictable and uncertain. Expectations can be confounded and trends can change. When this happens, the role of good government is not to hide away from or pretend this didn't happen, but to reflect on it critically. Explaining deviations and/or unexpected outcomes is a part of good, transparent tax governance. This is why we give the issue so much emphasis.
In video 25, we looked at the need for accounting data on tax collected by a government. Doing so, I'd highlight the importance of comparing tax collected in the year against the corresponding budget for the year, tax collected in the year and tax collected in the previous year, long-term trends, providing data in narrative as well as numerical form. Perhaps most importantly of all, as Andrew emphasizes, what is essential is that the data supplied assists the understanding of the objectives of the government or the tax authority for the tax system. Tax gap and tax spillover assessments are designed individually and together to help achieve that goal. In the next video, we look at tax gaps before moving on to tax spillovers.